China's decision to shut several chemical manufacturing units to rein in air pollution and protect the environment may benefit several chemical exporters in India. PI Industries may be one such company too, which the 60% of its revenue comes in from exports and likely to gain from this move. To talk about this in greater detail, joined by Mayank Singhal, Managing Director and CEO at PI Industries, and Yash Upadhyay from our research team to take this conversation forward. Yash, over to you.
So let me first start off with asking you about the benefits that most of these companies would get, because over the last couple of years we've seen Indian companies are believed to have benefited from the change in environmental norms in China, pushing up costs there. And as we speak to you today on the back of an extremely strong quarter for the company that saw profits rise by nearly 33% on a year-on-year basis. Is there room for further growth going forward, not just for PI Industries, but for the industry as a whole?
I think if you look at the agrochemical industry, yes, as rightly mentioned, there are the headwinds from China which have created certain challenges for the agrochemical supply chain worldwide. Definitely, Indian industry is well poised to take advantage of the situation. And I do see that at least for the next couple of years, organizations which in the agchem space will be well able to capitalize this opportunity for global exports.
And are these growth levels sustainable going forward? Because we've come across multiple brokerage reports recently pointing out to the fact that China may have relaxed its focus on pollution, potentially resulting in an increase in production there.
Let me answer that in two parts. One, if you look at the China reports which you're talking about from a point of saying that the global environmental norms will be relaxed. But let me also point out here that China is in any case upgraded the norms in one way or the other. A lot of the plants have been shut, which in return has pushed up costs. It's not that it's going to go back to the old old cost structure. So obviously Indian industry is far ahead and is meeting a lot of the global capabilities and norms. On the other hand, China is a producer of the basic chemicals where the cost structures have pushed. Whereas India and some of the key companies in this space are operating the value-added play. So this pressure would come on the basic chemicals, and if Chinese industry were to relax, yes, there would be easier availability that would bring certain costs down, but more so in the basic and commodity products. Now let me talk about Indian company growth. I think looking at the fears and challenges of China, a lot of global companies and Indian companies have put up basis for manufacturing for growth. So what I would say that we should not look at it a quarter-to-quarter basis, because quarter-to-quarter basis could be based on certain spurts and demands or supplies which need to be made within the quarter. But we must look at it from overall long-term perspective. And if you were to look at it from a long-term perspective, I would say Indian industry is definitely poised for a good growth. And coming to PI, I think we are a very good order book position, and we are confident of delivering a consistent growth over the next 2 to 3 years.
So the exports business for the last 2 quarters has been performing exceedingly well, even beating most of the street estimates. Could you help us understand what are the factors responsible for this, and is this a one-off on account of the low base?
As mentioned earlier, as you would be aware that yes, this is as per in expectation from the projection that we had laid out for the company. Clearly this growth is coming from expansion in capacities backed by a good order book position, and the company is in a steady state to deliver its projects and delivering the growth and the order book that we have. And on a consistent basis, we as projected earlier, we will continue to grow between 18 to 20% over the next 2-3 years.
Right, but so one of the key concerns for the business has to be the margins performance. In FY17, EBITDA margin stood at 24.2%. It came down to 21.5% in FY18, and for the 9 months of FY19, that number is even lower at around 20%. Could you help us understand why has this happened, and what are we doing in order to counter this? Secondly, are you seeing any signs of revival, if not a safer, growth in margins?
Sure, as mentioned earlier, the margins have been under pressure because of certain spurts and rises in terms of the costs of raw materials. And obviously we are in the higher end of the value chain, we are more where we are focusing. And on the other hand, the company has been investing to augment its capacities and to also look at expansion and overheads, which have contributed to this margin. But as we move forward and we get to the stabilization phase, you will see these margins pick up as you've seen in the last quarter.
So could we expect margins to recover above the 22% mark, say over the next couple of quarters?
No, we have already, as we stated earlier, the margins will remain around between 20 to 21% for the year.
Okay, sir. Domestic business, coming forward to the domestic business, erratic rainfall in the key agrarian states.
Yeah, and they'll nudge as we move up with growth.
Right. Sir, coming to your domestic business,
Sure.
Erratic rainfall in the key agrarian states as well as poor prices in key crop regions remains one of the biggest concerns for the company. However, the government in successive budget announcements have given a greater focus with initiatives in order to increase the farm income, by increasing the MSP as well. As a result of this, do you expect the domestic business to perform better going forward?
Yes, the domestic business for PI has done well and well within our expectation. I'm sure with the government initiatives, which is on agriculture, there will be more demand for throughput and from the farmer and to get more productivity and yield. And the basis of this, inputs would pick up. Although the ag chem is a very small part of the total value of agri-produce, not over more than 2 to 3%. On the other hand, please do appreciate that the agrochemical business is very dependent on very much on climatical conditions. And agriculture in India, unfortunately, is dependent on climate and water. And that can be only best answered as to how the weather reacts closer to the season for when the farmer is producing.
And a large chunk of that growth will have to be supported in the form of additional capacities and product innovations. Are there any such plans on the table, and if you can share the details of the same?
Yes, as you know that the company has looked at to embark on a 300 to 400 capex for the next year in order to build up capacities for our demands. On the other hand, we will be launching 3 to 4 new molecules in the CSM export business, and we will be also launching 2 to 3 molecules in our distribution business in India in the next coming year.
Lastly, sir, in an event where India were to replicate some of the measures in terms of the tightening of environmental norms, and as we've seen in the past with some of your peers as well, having been met with a ban on production, how well are you positioned to address this issue?
Well, let me answer that again in two parts. India as a country, I think, is very well in terms of global norms and processes which have been set up by the government for environmental management. And this has not been from now. It has always been in thinking and operation for the last decade. And it's only getting better, which I very deeply appreciate. And as a company, we believe in the highest standards of safety and environment. And the company has been very well recognized for that. We believe in creating benchmarks, just not following norms. We believe going beyond the call. And I think that's where I would say we have been very well validated, evaluated by global standards, by global partners, and have been certified with the highest ratings in that space.
Well, thank you so much, Mr. Singhal. We'll leave it at that. And thank you so much once again for taking the time out and speaking to us.